Okay, let's talk about HSAs and why the buzzword around them are their triple tax advantage accounts. And that's true. That's not actual TikTok hype or social media hype. So let's kind of get into the details. What is a HSA? So it's a health savings account. It's a form of a retirement account. So what does that mean? So that means that it's everybody knows typically what an IRA is, or a traditional IRA. They've heard of some Roth IRAs. They've probably heard of 401ks. So let's highlight the differences between a traditional tax deferred account. But before we get into that, what does tax deferred even mean? So tax deferred means the government, or i.e., the IRS, whenever you file your tax return, whenever you send it into the IRS, they are going to grant you a deduction. So let's say you contributed, I don't know, $6,000 to your traditional IRA. You get to reduce your taxable income by $6,000. Not you get to decrease your tax by $6,000. You get to reduce your taxable income. So that's a very key distinction. And then you throw your $6,000 into this basket called a traditional IRA. It grows for the next 30, 40 years. Whenever you're old and pruned, you can withdraw that out, and then you're taxed. So it's not taxed beforehand. It's taxed whenever you withdraw. That's why there's penalties for early withdrawal, etc. They want you to keep that money in that market, or in the market. Um, so number one, you don't pull out capital from the stock market, and number two, if they're going to give you a tax break, if you withdraw it early, they're going to slap you on the wrist. So that's kind of the gist of how an IRA works. Why that's important, and that's not super in detail with how an IRA works. But back to the HSA, the health savings account. The main difference is it works just like an IRA, except whenever you withdraw the money, if you use it for qualified medical expenses, they don't tax you for it. So it's tax free. So, number one, you get a tax deduction whenever you contribute to an HSA. Excuse me. Tax free growth. It grows within the HSA, for 30 years, 20 years, 10 years, 40 years, however long you want to grow it. So it's tax free growth. And then the withdrawals on that money, if they are used for qualified medical expenses, are free. So there's no tax. But with an IRA, it doesn't matter if you withdraw that money for medical expenses, cancer treatments, dental, vision, eye doctor, whatever, that it's going to be taxed, hence tax deferred. So that's kind of the main benefit of why people like HSAs. And they're really popular, honestly. So let's go over, well, okay, Brooks, that sounds great. I never heard of one. Maybe you're in the income level where you're interested in potentially setting one up. You're like, oh, okay, well, I already have an IRA, or maybe I don't have anything, but you want to start an HSA. So, how much can I contribute? How does that impact my taxes? What exactly do I need to do? So, I'm going to set a precursor rule here. Everyone's tax situation is completely different. Please consult a tax professional that is yours, or you can even consult me. I have my links down below. We can send me an email or comment down below. But this is just a very basic example. This may not apply to your situation. I'm just saying as a generalized rule. So disclaimer out there first. Let me get a drink of coffee. And don't judge me for the Merry Christmas. I love these cups. Shout out to my wife for making this. She's awesome. Anyways, back to the HSA contribution limits. The HSA contribution limit for individuals is for 2024. Pull up the wrong table. Is $4,150, and for individuals with family coverage, it is $8,300. And you're saying, okay, that's great, Brooks. How exactly does that help me with taxes? Great. Let's break it down. So let's just have easy math. Let's say you're an individual. Let's say you are single. Let's say you make $40,000, and let's say after your standard deduction, and you get let's say that's all you have is you work your. Let's say you have a job at being I don't know, you sell snow cones, whatever. So you get your W-2, made 40,000. Your taxable income's roughly, let's call it 28,000. before we factor in the HSA contribution. So essentially, let's say you have just individual coverage, and for the math to work out on that, for your $4,150 maximized contribution, effective of a tax rate of 10%, you save dollar for dollar in taxes $415. Meanwhile, you put roughly 4 grand into a retirement vehicle, and not to mention the tax-free growth. And whenever you withdraw it, whenever you're old and pruned, you can withdraw that money tax-free. So let's say you contribute, max it out. Let's say it's worth $500,000 at 65, and finally, your eyeballs go out at 65. They're just not what they once were, and you can't drive the same. You got whatever. So you need some glasses. Cool. And then maybe you need eye surgery or whatever. You can withdraw that money all tax free. You still have to report it. I can't tell you the rules, 60 years in the future or 30 years in the future, but I'm sure that you'll have to report it on some form or schedule on your individual tax return. But the premise is that's why people really push this HSA account, and hopefully this kind of demonstrates why it's beneficial for you and why it's different than a FSA, a flexible spending account. The main difference is an FSA, you kind of use it or lose it. So at the end of the year, if you contributed $500 to your FSA, and you don't use it by the end of the year, then you just forfeit the money. So that's kind of the main gist. The HSA accumulates in value. Your contributions are invested in some type of retirement vehicle, whether that be the S&P 500. You invest it all in crypto. You invest it all in real estate, ETF, whatever you want to do. So that's kind of the premise, and I hope that that kind of helps out, makes you understand why people kind of push the HSA so much. And let's just do one last calculation. Let's pretend that you had a family coverage. Let's say you womped in $8,300 for the year. So that's effective tax rate 10%. Let's just call it $830 dollar for dollar savings. So you effectively, by contributing $8,300, you reduce your tax bill by $830. And again, that's simple math. The U.S. tax system is a waterfall method. So again, that's kind of a side tangent, but again, this is simplified math just to kind of get the knowledge and education out there. So I hope this was helpful. If you have any questions, always leave them down in the comments below. I highly recommend you kind of look these things up, and feel free to reach out. Get me on Twitter. Reach out in the comments down below to learn more about it. Awesome.